Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We always think about managing our properties, but do you give much thought to managing your debt? In most cases, the lender provides most of the money, and yet a lot of real estate investors just set it and forget it. Today, we're going to talk about how you can optimize your debt for greater profits and smarter investing on the Real Estate Guys radio program.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com. or look under the Events tab at realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, in the co-host seat, it's our financial strategist, Russell Gray.
Hey, Robert.
One of the coolest things about real estate is that you don't have to come up with all the money up front. The principle of leverage says that if you come up with a reasonable down payment, say 20% of the value of the property, you can find someone like the bank or, as we learned last week, a private party to finance the rest. We call that leverage. You're leveraging the use of capital. You have some skin in the game, 20% down, and say the bank loans you 80%. And that's an age-old concept in real estate. Now, lots and lots of years ago, there was no such thing. But as we've seen the markets evolve, lots of providers of leverage exist today. Credit unions and banks and funds and private individuals and syndications and all kinds of ways to come up with debt. And one of the questions that we get a lot on our Ask the Guys shows is, should I pay my mortgage off, or should I pay it down, or should I use that money to buy another property? Another version of that question is, as I'm building my portfolio, am I better to have fewer properties with less loans against them or more properties with more loans? And the first answer is, it's a big old, it depends. I think that you can make arguments on both sides, and that's what we're going to attempt to do today, as well as share a concept we call optimizing your portfolio.
Yeah, I think the story about debt is a huge one, and it really is the story of real estate, but it's even bigger than that. It's really the story of money and the financial system. Real estate is arguably the best asset. Everybody knows that, and so it makes the best collateral. Therefore, the people who are in charge of things, who created a system of perpetual debt, like to issue debt and like to have it secured by the best asset. The other best asset is the population. So you've got treasuries, which is considered to be great debt backed by the full faith and taxing power of the government. And then you have mortgages, which are backed by real estate and the earning power of the borrower. So that's kind of the basis. Out of that come all kinds of incentives and motivations to use debt. So it's among the cheapest, best debt you can get. Tax deductions, long amortization periods, fixed interest rates forever, subsidized, really low. The list goes on and on and on and on. So when you're in a system and you look at the rules of the game and you understand the way the system is set up and the way it's rigged and what the system operators really want you to do. The question is can you find a way to do it that is congruent with what you're trying to accomplish? In other words, does it make sense? And I can make the argument all day long. Yes, it makes sense. With that said, do you never want to have a property that's paid off? Well, no, of course not. I think there's a time and a place for that, and we'll talk a little bit about that. But strictly speaking, from the economic perspective and from the mathematical perspective, leverage is your absolute best friend in real estate investing.
And you've seen this if you've ever gone to purchase a car. You have a car in mind, you go to the lot, you're visiting with a dealer, and they want to get you into this fine automobile with a low monthly payment. And you don't ask as much about interest rate as you ask about how much will this cost me every month. And that's just a matter of turning your purchasing power into a big stack of cash, which pays for the car. And most dealers today would much rather you finance a car than pay cash. I can remember buying a car 20 years ago, and I got a pretty good discount when I paid all cash. Recently, I bought a car for all cash, and it was the other way around. The dealer was really trying to get us to, get it financed because they make so much more money that way. Anyone who's ever read the Truth in Lending statement when you've closed escrow on a property knows that the amount you borrowed is $210,000, and the amount you're going to pay back over the life of the loan is like $685,000 because it includes all of that interest. And interest isn't a bad thing, but interest is a cost. And so as we're approaching real estate, it's so expensive. It's not like a $20,000 or $30,000 car. It might be a $400,000 or $500,000 property. That's a lot of money to accumulate in one pile. And so leverage gives us this awesome tool, whereas we can bet on the income in the future. Meaning if I'm buying a fourplex, and I know I'm going to have tenants. Now, I might not have 4 tenants all the time. I might have 25% vacancy every now and then. In an extreme case, I might have 50% vacancy. I'm probably not going to have more than that if I buy in the right area and pick the right property manager. So I know I'm going to have income to pay the mortgage. That's a different value proposition than a homeowner that says, well, I have to make enough money in my job and investments in business to be able to afford the monthly payment. But that monthly payment allows us to bring that big piece of property from the future into today.
Well, I think you're making a great point in that interest is a cost of doing business. It's a business expense. If you're not doing business, you don't have a source of income or profit. You may make the argument that it's not a good thing to have, right? I'd rather be debt free. And that goes back to the core basis of thinking, your paradigm, which is, are you a consumer or are you an investor? So consumers earn money by the sweat of their own brow, their labor. They trade time for dollars. They pay their taxes. They live below their means. And, everything is an expense. And so they try to keep their expenses down to maximize their savings. And then at some point, if you generate some savings, you want to invest it because savings these days is worthless for many reasons we don't have time to go into. But the idea is that you want to put that savings to work by investing it in something that can grow faster than inflation. When you flick that switch and go from being a consumer to being an investor, your mentality about debt needs to change. You need to understand that, the idea of I need to reduce my gas bill, so I'm going to quit my job and I'm not going to go to work. That way my gas bill goes down. It's the same thing as saying, I don't want any debt in my life as an investor. You're going to have debt. You're going to have expenses, interest expense, which is the debt expense. And the key is, do you make a profit on that debt? And of course, at today's interest rates with the taxes and inflation and all of the things going on, the answer, subject to all of the risks that come with any investment, is absolutely you make a profit on it or you shouldn't be borrowing. So once you get your mind around that, the decision to use debt or to not use debt gets a whole lot easier.
Well, it sure does. And we talked last week near the end of the show about the idea of arbitrage, which is what banks do. They borrow money from you at one rate and they loan it out to your neighbor at a higher rate, and they make the spread, the difference. Well, we do that as real estate investors. If I can find a real estate investment that can return 7 or 8%, and I can borrow the money for 3 or 4%, then how much money do I want to borrow at 3 or 4% if the return on it is 7 or 8%? And the answer is a lot, as much as possible. Or our favorite answer, all of it. If you can make money on the spread as a real estate investor, you want to do that. That's why our friend Robert Kiyosaki loves debt. He actually loves debt more than he loves real estate. He's a real estate investor through and through of all the various things you could invest in, and he invests in different things. He loves real estate, but he loves it because he can get debt on it, and that's a good thing. Now, before we go down the debt path, and there's a lot to it, it's not as simple as, do I take a loan on a property or not? There's so much more when it comes to the thinking of paying it down over time. How long is amortization? When do I refinance? All those things we're going to talk about today. But before we start that, let's just play the other side of the coin, which is, why would you buy a property for all cash? And there are some reasons. And I think the first reason is, for some people, buying especially their home for cash or paying it off completely over time gives them peace of mind. They know that if anything were to happen to disrupt their income stream or their lifestyle, they would have their house. And if that lets you sleep better at night, that may not be the best financial reason, but that is a reason. People want to own property free and clear. Another reason is it's old thinking, right? Folks that grew up in the Depression had a very different idea of debt than people who grew up in the 80s, and they had a different idea than people that grew up in 2000s, right? So how you approach debt also depends on how you were raised, what your patterns are for money, and having an understanding of the things we're talking about, that debt isn't a cost or expense. Debt is a tool to make you money.
Yeah, well, I think you have to understand the environment that we're in. The world changed. The world initially changed in 1913 with the formation of the Federal Reserve and the new financial system. That's kind of ancient history at this stage of the game, but the result was you could print unlimited amounts of money, and they did, and that created a big boom called the Roaring Twenties, not the 2020s, the 1920s.
Right.
And that culminated in the Great Depression, which you just referred to, Robert, where everything contracted because they printed too much money too fast, and it imploded upon itself, which is what happens when you introduce too much debt too fast. And you could make the argument we're going through that right now. We'll see. With that said, in 1933, they took gold out of the system effectively from United States citizens, but really sealed the deal in 1971 when Richard Nixon took us off the gold standard. If you go back to the Federal Reserve, you know, the St. Louis Fed prints all these charts you can look at, you'll discover that after 1971, the world became debt-driven. And our friend Richard Duncan, who wrote The Dollar Crisis, said we went from capitalism to creditism, and everything became credit. And so instead of having money in the system, which is an irredeemable source of store of wealth and medium of exchange, which is what gold-backed currency and gold was and precious metals back in the day, we went to a debt-based system, which is what Federal Reserve notes are. We just did a show about notes, and notes are IOUs. A Federal Reserve note means the Federal Reserve owes you something, but they don't specify what it is they own you. The point is it's all debt. You're operating in a debt system. And so mortgages is just a method of payment in order to operate. And because the world is awash in debt, the Federal Reserve, who issues the currency, has a mandate. They consider it a mandate. In fact, it's printed on their website to inflate by 2% or deflate the value of the dollar by 2% every single year. So if you know you're in an environment where inflation is going to be forced upon you, and the thing is that 2% inflation doesn't spread out evenly across all assets, and history says that real estate has been the disproportionate recipient of inflation, meaning when they're putting 2% more money in the system every year, real estate ends up growing by 6 or 7% historically. And so that's just on the equity side. And of course, as I'm sure we'll discuss shortly, leverage magnifies that appreciation and really gives you a chance to outpace inflation. So, Robert, you mentioned that Robert Kiyosaki and his real estate guy, Kenny McElroy, which I'm sure is where Robert learned a lot of it because Kenny's a brilliant real estate investor. In fact, you get a chance to hang out with Kenny McElroy at our upcoming Investor Summit. And what you'll discover is they don't look at real estate as the investment. They're acquiring debt. Real estate is the tool to acquire debt, not debt being the tool to acquire real estate. And that is another paradigm shift that you'll discover if you hang around people who would take their real estate investing very seriously.
So back to the argument for not getting into debt. People have an aversion to debt. And let's talk about this. There is good debt and there's bad debt. Bad debt is when you pay 18% on credit card debt to buy something that's declining in value and collecting dust in your garage. That's bad debt. Good debt is when you buy an asset that puts money into your pocket, like investment real estate. So not all debt is bad. That's a paradigm. But there are some reasons why owning a property outright can make sense. Sometimes, due to the nature of the property or the borrower, there is not a suitable lending partner available. This is common when, say, you have someone who does severe rehab, like they're buying the super ugly duckling and doing a lot of work to fix it up. Many lenders are not interested in that collateral. As you mentioned, Russ, the collateral of real estate is some of the best collateral there is, meaning lenders feel safe and confident when they have a nice piece of real estate backing a note. But if it's not a nice piece of real estate, you may not be able to get a note. So a strategy there is we buy for cash, we fix it up, and then we refinance. So we call that flip and hold, where you're not actually flipping the property. What you're flipping is the financing. That takes some cash up front. Sometimes also land. Hard to get loans on raw land. Now, if you're in the development business and you have a big track record, it's certainly possible, but for the most part, land is a cash purchase. And what you do to the land to increase the value, you can certainly bring in financing, construction financing, bridge loans, all kinds of ways to do it. We'd like to raise private equity to do those kinds of things. So that's another reason why you might want to own outright. And then a final reason is just, I'll share you an anecdotal reason. Back when we were doing bigger development projects and getting into debt on a massive scale, $8 million, $10 million, $15 million loans to build out a construction site, the bankers would look at our balance sheet and they would look at what they call contingent liabilities. That's all the things that you've agreed and signed that you're responsible to pay. Your mortgages, your notes, your car payments, everything. And they would base their risk assessment on how many contingent liabilities you had. If I had a piece of real estate in my portfolio that was owned free and clear, no debt, they loved that. And so I made it a practice for 6 or 7 years to always have a pretty decent property that was debt-free, just because it gave me that nod. I'm not saying it would be worth it today, but it was worth it for our business then. And you know what? You do have that peace of mind factor. There's also places in the world where it's very difficult, if not impossible, to get financing. Having invested in several other countries, some countries just do not have a capital market for real estate leverage. So you have to buy for cash. And frankly, that's not all bad either. But I think the best thing we can do with the rest of the show is talk about strategies for managing your debt. We'll give you some ideas that maybe you haven't thought of when we return. Your turn to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year, our sales legend Tom Hopkins, the editor of the Gold newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit. When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hello, everybody. David Stockman. I'm the author of the Contra Corner blog, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Tell a friend about the Real Estate Guys. Even though we have tens of millions of downloads, we could use a few more. We're talking today about managing your debt for greater profits with real estate. Debt is such an integral part of a real estate investment, and for too many people, I think it's set it and forget it. They bought the property, they put their 20% down, they got a loan, they got a tenant in, they got a manager, and then they're off to the next thing. But what we're going to talk about today, hopefully, will expand your mind a little bit to think of, as Russ was saying, the debt as a tool and the debt as the investment, and therefore we want to optimize that investment. So to talk optimization, we have to get through a few things first. And the first is the whole concept of leverage. In order to borrow money, you have to be credit worthy. Often on the show, we talk about, especially to young people, how important it is to maintain your credit score. We've seen too many people when they were young do stupid things and ruin their credit score and then have a real hard time starting way before the starting line trying to catch up to their peers because they were not credit worthy. So having the ability to borrow is critically important.
Absolutely. It's your most powerful tool. So we talk about your investor resources, the things you have in your toolkit. You've got cash flow, equity, and credit. And then the three other things are time, talent, and relationships. So obviously, as a young person, you may have time. You may not have talent yet, but you can acquire that or you can partner with that. And that's part of what you get out of your relationships. But looking on the financial side, you may not have a lot of equity, or you may have no equity, and you may have no debt acquired yet, which is really a resource. But what you do have potentially is income and a credit score. And income and a credit score will get you a loan, because we talk about, as real estate investors, we're interested in acquiring debt. But what lenders are interested in acquiring is payments. They want your efforts. They're trying to get you to get up every day and send them a piece of your income, and that's what they invest for. Real estate investors put themselves kind of in that flow. So starting out, in order to kind of get your fingernails on that freight train of equity growth that's running away from you, you just got to run as fast as you can, grab on with something that you feel that you can reasonably maintain, starting with a good credit score and a predictable source of income. And then you lever that into a property, hopefully something in the right market with some upside that you have some control over, forcing equity. Again, different discussion, but you got to get in the game. And the point is that your credit score and your cash flow is your tickets to getting into the game of using leverage.
Well, and let's talk about what some of the buffet of choices are. And we're big proponents of sitting down with a lender professional, a broker, somebody who understands the business, who can work on your behalf to find you a great loan. But the things you need to be thinking about when you're purchasing property using leverage is, how long do I want to be in debt? So amortization is the slow pay down of the mortgage. And let's say I borrowed $80,000, 80% on a $100,000 purchase. I put down $20,000 or 20%. I've got an $80,000 loan. Now I'm going to make the payments, and they're going to be amortized over some period of time, 10 years, 15 years, 20 years, 30 years, 40 years, pick a number. Typical loans on single families might be either 15 or 30 years. What that means is I'm going to have my $80,000 paid back by dividing the entire cost over all of those years, and I make the same payment every month. And when I make the very last payment, the interest has all been paid, the principal has all been paid, and I own the property. As you look at any amortization table, you'll see that in the beginning, when you make your payment, it's almost all interest and a tiny little bit of principal, meaning you own a tiny little bit more of the house. Instead of owing $80,000 against it, you now owe $79,984, and that little $16 bit that you captured is your part of your payment, and that comes right back on your balance sheet. Over time, even though the amount of the payment doesn't change, the proportion of how much is interest and how much is principal changes, to where your last payment in 15 or 30 years is almost all principal and hardly any interest. And the reason it's important to get this far into the weeds is it's another paradigm. We saw 10 years ago, when interest rates were hitting lows, that people would, wake up, have their cup of coffee, and refinance their house because there was a lower interest rate and it made economic sense. But the thing they forgot about is every time you refinance, you push the amortization table further. So let's say I got a 30-year mortgage, amortized over 30 years. I pay down for 5 years. Most of those payments, interest. Now I refinance. Hey, because rates went down half a point. Okay, so my payment went down a little bit. But I now start that 30 years over, and I have now 5 more years to pay at the end, and the first 5 years of that new mortgage, mostly interest. I'm not saying you wouldn't refinance for a lower payment, But you have to think further than that. If you're a real estate investor, it's not just about your monthly payment. It's not just about your interest rate.
Well, I mean, I think the point that you're making, going all the way back to what you commented earlier about the cars, is that people do that because they're fixated on the payment and they want to improve their cash flow. Most people don't expect to be in that same property that they're doing the transaction on 10, 15, 20, 30 years from now. You need to really think about that if you're like in the dream home and this is going to be a property you're going to keep forever. And that's the plan. It's a heirloom property, if you will, and you're going to pass it on. If that's the case, then your financing decisions are going to be a little bit different, but it would also put you in the minority. Most people are not going to keep that property long term. So I'm not suggesting you go with short-term financing like adjustable rates in an environment like this. We used to do that when rates were falling. I think there's a lot more risk of rates rising. In fact, we're experiencing a little bit of that now, although I don't think that's going to sustain, but time will tell. But there's just not very far for them to fall. So the difference between a short-term loan and a long-term loan is not that much. And to me, the stability of knowing that you could stay in the property longer time in a high interest rate environment and have a competitive edge, especially if you convert it into a rental property, then that's probably worth doing. But the point is, you do have to understand what you're doing when you make a strategic decision to refinance. Most people are going to do it for the cash flow. Not even the interest rate is that interesting. And then once you understand that what you're trying to do is refinance and that you're not going to be paying down the loan that fast, and you don't care, then you might say, well, why wouldn't I want to get an interest-only option where I'd have an even lower payment, not pay anything down? And the answer is that you probably would want that. Then that kind of opens up this whole idea. Why would I ever want to pay the property down if I'm only ever going to want to refinance to pull the equity out? Why put equity in that I'm going to have to pull back out? So again, these are major paradigm shifts. I've done this for a very, very long time. I've talked to thousands of investors, done seminars, all kinds of consultations over the years, especially when I was back active in the mortgage business. And the reality is that most people don't know how to use debt, not because it's complicated, but because they have these paradigms stuck in their brain that don't allow them to see how to use the tool.
And it is a tool. And this is what hopefully today is a wake-up call, so you understand that leverage is an awesome tool. In fact, one of the best tools we have in real estate. Because the lender's willing to take that predictable stream of income, it means you get all the upside. So we love that. Just take the example we gave on the $100,000 property. You put down $20,000, the bank put down $80,000. When that house doubles in value and it's worth $200,000, how much of that extra $100,000 does the bank get? None of it. You get all the upside. So we love leverage, but it's the set it and forget it mentality we want to break the paradigm for. Yes, if you're going to live in your single family house forever, great. Pay off the loan and it's all yours and it's all good. Then maybe your heirs sell the house or refinance the house at some point. But for most of us, that's not how it's going to work. And we need to be mindful of the market, what's happening in the market. And just before we leave that point you made, which is a great one, Russ, and it went by fast, why would you pay off a mortgage if at some point in the future we're going to borrow the money back? And I've heard it say this way: here, Mr. Banker, here's $100 to pay my loan down. If I need that $100 back, I need to requalify for it. I need to prove that I can pay it, and I need to pay you points and fees to get it. So think about that for a minute. You've already got the money. What is the urge to get it back? It's a tool. The longer you have the tool, the more money you can make.
Yeah, absolutely. And I want to break the paradigm of the set it and forget it, because here's what happens. And I'm just going to use simple math. You have to do the math, and it's hard to do that on the radio. I get it. But if you have a property that is appreciating, and I'm just going to use really, really round numbers to make the math simple. But let's say it's appreciating by 2% a year, which is fairly modest, and you own it all out. That means that every year on your capital invested, you're growing by 2%. If you put 20% down, like a typical loan, and that's 1/5 of the property value, and you put the other 4/5, which would be $80,000 as a loan, then when the property goes up by 2%, you're getting 2% on the $100,000 in this case, which would be $2,000, but you're getting it on your 20. So that's a 10% equity growth rate on the equity you have in the property. See, and that's because 2% times 5-to-1 leverage, you have 5 parts, right? 1 part is equity, 4 parts are loan. It magnifies. So it's 5 times 2 is 10. That's how you do the math. Well, so you don't have to be a rocket scientist to figure out that if you have 50% equity in the property, then you're at 2 to 1, and 2 times 2 is 4%. And again, you don't have to have a PhD in mathematics to understand that 10% is better than 4%. And so if you have a property that you bought at 20% down, but through appreciation and amortization, it's now gone down to 50% loan to value, meaning now your equity is only leveraged 2 to 1, your equity growth rate has dropped from 10 to 4. And that's what we call you're losing velocity on your equity. And in order to reestablish that velocity, you have to reestablish your leverage ratio, which means you have to put more debt on the property. And then you say, well, okay, then what do I do with the equity? Well, that's a different discussion. But the point is you use the debt to magnify the leverage on property A, and then you can use the freed up equity to go do property B, go make loans, go buy precious metals. You can do whatever you want with it, and we can have all those discussions. But the point is you have to understand when you set and forget, your velocity on your equity is systematically going down without you even noticing it's happening.
So how do you actively manage your mortgages? That's what we'll talk about next. And we'll play real estate trivia so you can win a prize. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hi, this is Garrett Sutton, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate and Start Your Own Corporation. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate, paper, and bullion holdings with the right mix of LLCs and corporations. Our firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention the Real Estate Guys for a free bonus. That's 800-600-1760 or corporatedirect.com. We look forward to assisting you at corporatedirect.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, I'm Mark Victor Hans. You're listening to The Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. One of the coolest events we do every year, we only do once a year, and we didn't even do it last year. It's called How to Win Funds and Influence People, a 2-day workshop on sales training, persuasion, influence, and good old-fashioned belly-to-belly sales. You get all the details on our website at realestateguysradio.com under events. We're talking today about how you can manage and optimize your debt for greater profits. Before we get back to that discussion, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question. In just a minute, I'll give you a question that has something to do with real estate. And when you know the answer, or you just want to guess, send us your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll need to send us your name, the answer to the question, and your mailing address. Because if you're first to get it right, you're going to get the Advanced Guide to Real Estate Investing, how to identify the hottest markets and secure the best deals by our good friend Ken McElroy. That can be yours if you know today's Real Estate Trivia question. Last week we had Jim Griffin on the program talking about investing in private mortgages, and we asked this: where is the world's highest river? It's called the Yarlung Tsangpo River. It's 1,765 miles in length and passes through 3 countries, India, China, and Bangladesh. And it starts at an altitude of 14,800 feet, making it the highest river in the world. Here's our real estate trivia question for this week. Where in the United States was the shortest fishing season on record? Yeah, lots of states have, rivers and brooks and lakes and even the ocean. And in many cases, there's a season where you can fish for certain things. Well, in the U.S., where did the shortest fishing season on record take place? If you know, or you want to guess, send your best guess to trivia@realestateguysradio.com. Give us your name, the answer to the question, and your mailing address. First person to get it right gets the Advanced Guide to Real Estate Investing by Ken McElroy. That's today's real estate trivia question. We're talking about how do you manage debt so you can make more money in real estate. Debt is not an expense. It's a tool, and it allows us to make money. That's why we love it so much. When you think like a consumer, you think all debt is bad. When you think like an investor, you think, where can I get my hands on more debt? And when interest rates are at 2, 3, and 4%, we're like kids in a candy store. So as you're thinking about acquiring more real estate with debt, a couple of things happen. The first is that your ability to qualify changes. So no investor left behind. If you bought your first investment property, and maybe you already own a home that's in your name and you have a loan on that home, then the borrower, you, are going to have to show that you have the ability to pay the loan. And you might get a little credit for the fact that it's going to have tenants in it, but for the most part, for single-family homes, you're going to be the person that has to have the income to qualify for the loan. Now, take that out to the extreme. 20 years in and you own 1,000 units, you buy an apartment complex. What you make doesn't really matter. The apartment complex has to qualify for the loan through something called a debt coverage ratio. And we won't get into the details of that. We did a show in the first of the year with Anton Matley, who's a commercial mortgage professional, and he kind of runs through that. So you can go back and listen to that show or ask your lender about how all that works. But somewhere in between, you get to a point where it gets more difficult to get loans. And this is why you have to be strategic. So the rest of the show, we're going to talk about how you can strategically manage your debt in a way to make even more profit. Set it and forget it is one level. We've already said that's maybe not the best way. So how can we be strategic? Well, lots of different ways. The first one I'll talk about is this. You maybe heard us say on the show, and for folks who've been around a while, bear with us, you know this terminology, that someone is Fannie or Freddie'd out, which simply means that the loans that are typically part of Fannie Mae or Freddie Mac, the traditional loans that are out there for 1 to 4 units, that you can get only a certain number of those before the lender feels it's too risky. Doesn't mean you can't get more property, but when you do, you generally have to, 1, put a little more down, maybe 25 or 30%, and 2, pay a little higher interest rate as a premium. And the whole premise, we talked about it last week with Jim Griffin, is if I have 15 houses, I'm more likely to walk away from number 16 if there was a problem than if I only have the house I live in. So it makes sense that as you have more debt and get more in debt, that you don't get as good a term. So I think the first thing for us to talk about in strategy is making sure you're smart when you pick your first 4 or first 10 loans.
Right, absolutely. Managing your capacity for the best loans available, the Fannie and Freddie loans, assuming you're willing to be a residential 1 to 4 borrower or investor. And that we ought to take a step back real quick. Basically, when it comes to financing, there's 2 categories. They're very simple. There's residential 1 to 4. And there's everything else. Everything else is basically considered commercial. And the reason residential 1 to 4 is its own animal is because way back when, in the, I think of the 40s or the 50s, the government came in and created these government-sponsored enterprises, GSEs, called Fannie Mae, Freddie Mac, VHA, FHA, all that. And the reason they did that is because their goal was to make housing more affordable. Of course, it had the exact opposite case, which is what always happens when you try to make something more affordable. You create more purchasing power, more demand, and then people bid the price up. But the fact of the matter is that is the way it works. And so they're not interested in empowering real estate investors to become real estate moguls, but they will allow you to create some affordable housing and play in the space up to about 10 of those loans in your portfolio as an individual borrower. If you're really, really smart, you can get to 10. And if you're really smart and strategic with a partner, like a spouse, you can get to 10 each and have 20. But you have to begin with the end in mind, as Stephen Covey says. So you have to work with somebody who knows how to play that game, and you need to start on property 1 knowing you want to get to property 10. That's one part of it. The other part of it is you may decide, well, gee, I could do a single family home and get 1 tenant and 1 loan, or I could do a 4-unit property and get 4 tenants and 1 loan. And so you could say, well, I could end up with 80 doors if my partner and I both got to 10 and we only bought 4plexes. And so part of the strategy is driven by how you can get the most out of the debt that's available. Now, with that said, you may end up feeling like from a risk-adjusted return, single-family homes might be a better place to play. They're a little bit more liquid because you can sell to homeowners, just like you can rent them out. You know, if you listen to our friend Gene Garino, there's other things you can do with single-family homes that are harder to do. In fact, you can even turn them into multi-tenant properties. So that's a different discussion. But all that to say is that if you want to take advantage of this government subsidized 30-year amortized, very available financing, then you start out with a good credit score and your personal income, and then you work with somebody who knows, a mortgage professional who knows how to work you all the way through to get you to the 10. And then you can kind of start there. And then you use the equity that you create in all of that and the experience you get on your resume to move up to multifamily or other forms of commercial investing.
Now, there's an advanced strategy there. As soon as you have 10 loans through some pretty cool tools, our friend Billy Brown just talked about this at our Secrets of Successful Syndication event. There are lenders who specialize in packaging up a group of loans and liquidating them, meaning I might have those 10 houses with 10 loans. I talk to Billy, he puts me into a single loan that encumbers all the property, and it frees up my qualification. Now you're going to pay a little more interest rate maybe, and maybe some points on that. And a consumer goes, whoa, but that's more expensive. But an investor goes, yeah, but now I get to that early qualification on those 1 to 4 unit properties. And that's the best mortgage money I can get. If you were to do the math would tell you what to do. And that might be a really great tool. Some of you just earned the price of investing an hour in the show with that because you didn't even know it was possible.
Well, and the other distinction here is understanding that with your personal income, if the property is a little tight on cash flow, normally when you acquire an investment property, you're going to get credit for 75% of whatever the scheduled rents are. And if you're short on your debt to income ratios, you can make that up with your own personal income. So if you have strong personal documentable income, then you can push that a little bit. And that may make sense if you are buying a property that in a market that's in an upswing, or you have a plan for increasing the value. I wouldn't stretch it on a property that's already at the top of market and there's no room for improvement, because you're just using your own income to overpay. But with that said, to your point, Robert, when you move up into commercial properties, then it's a lot more about the property's income, and you really can't bring anything to the table other than your management expertise and a strong balance sheet. So there's some things you can do in terms of optimizing your leverage in the residential 1 to 4 space that can also make a lot of sense. You just need to pick your markets, pick your properties, and certainly pick your property managers very, very carefully.
Well, we talked a little about amortization and the length of amortization. You know, a lot of folks who own their own home decide when they refinance to go from a 30-year amortization to a 15 because it lowers the interest rate and it pays the house off sooner. But as investors, if we're not interested in paying the loan down, we're interested in getting more debt, then we might look to longer amortization. It's one of the things to consider as an investor. It helps your cash flow in the beginning. Yes, over time you pay more interest, but hopefully we've already dealt with that part. Now, when you jump into commercial, there's another consideration. Those loans that are 1 to 4 loans, those can be paid off pretty much at any time. Once I get an apartment complex of 150 units and I get a big commercial loan on that property, it's going to have a minimum amount of time. And again, not going to get in the weeds on this. You can listen to the previous shows we've done with commercial lenders to learn about this idea, but just know that that's not as flexible. I can't wake up one day and interest rates are down 0.5%, so I refinance my 150 unit apartment complex. If I do that, I'm likely to have to pay a big old, think of it as a prepayment penalty. We call it defeasance or a yield maintenance clause. But the lender who puts that much money to work wants to make sure it stays at work, whereas the 1 to 4 unit loans are so liquid and there's so many sources for that they're being refinanced and changed and bought out and sold all the time. So you also have to be strategic. So this is, again, the part about figuring out the strategy. You might get all inspired by the folks that are doing big apartments and go, yeah, apartments are for me. If you've never invested in real estate, there's a really good chance that you're not eligible for an apartment loan right now. Today's lending environment is not the same as 20 years ago. Today's lending environment, the lender wants to know that you have history, experience, and you're a good bet, not just from your FICO score perspective, but from the history you have in real estate and your experience resume. So sometimes you have to bring a partner in who has that. So it gets complex, not to scare you away from it, but just to know that the more you use this tool of debt, the better you have to be at understanding how to use it, because it's not just like a screwdriver. That's like a full-on tool belt.
Yeah, I mean, if you want to play in the multifamily space, you're probably going to need a partner. You're almost certainly going to need a mentor, because I did my first apartment deal with you. The only reason I got it is because I did it with you, and you had that on your resume already. I didn't. But once I had done the deal with you, now I had the deal on the resume. It didn't change me one iota. I was the same person I was before I did the deal. You found the property, you found the lender, you brought me in, you sat me down, I signed the papers, and all of a sudden I'm experienced, right? I hadn't done anything. I didn't know anything, but I had a partner. So, you can kind of game the system, if you will, a little bit. So, a partner will help you get the loan. But the reason you want to have a mentor is because even though you qualified for the loan with somebody else, it still doesn't mean you know what you're doing. And at the end of the day, the lender has that requirement for a reason. And so it's probably smart to have a mentor. We have a guy we work with, Brad Sumrock. He's got a program you can find out about by sending an email to Sumrock, SUMROK, at realestateguysradio.com. But Brad has mentored many, many successful apartment investors, and he knows all about this stuff.
We're talking about managing debt for greater profits with real estate. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from April 16th to 19th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now. And with the Belize airport open again, our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown. And with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me April 16th through 19th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market seems interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trips. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, April 16th through 19th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hey, this is John Asraf, and you are listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks so much for tuning in today. Hey, there's an event we do only once a year, and it's coming up in just a couple of months. It's called How to Win Funds and Influence People. It's a class on sales and influence and persuasion, and it's awesome. You can get all the details on our website at realestateguysradio.com. Under the tab that says Events, How to Win Funds and Influence People. We're talking today about managing your debt, and it really is something you manage. It's not something you just get into and make payments on. And so, Russ, let's talk about, in our remaining moments, this idea of optimizing your portfolio. As a real estate investor, I'm putting things into my portfolio. I bought a rental house, and I bought a duplex, and maybe I bought a couple of fourplexes side by side. And as I'm qualifying for these loans, I'm getting mortgages, I'm owning property, I'm seeing what's happening with cash flows. How often and how do we optimize our debt?
Well, it's a math question. The reason you want to do it, as I stated earlier, is you want to reestablish those leverage ratios and keep that leverage working for you. So the concept of optimization is about keeping your equity working, not letting your balance sheet fall asleep. There's a lot of lazy balance sheets, a lot of lazy equity out there. And so our goal is to free that up and put it to work. And there's a lot of different things you can do with it, and you have to be smart about that. Arbitrage is a basic concept you have to understand to do it successfully. But generally speaking, when I've done the math, when you get to about 35% accumulated appreciation on top of what you put in, you probably ought to start taking a look at doing a cash out refinance and then working with your mortgage professional to understand what the current loan programs are, what the current qualifications are, so that you can begin to plan that. And then at the same time, concurrent, once you kind of have an idea what your costs are going to be or your cost of capital is going to be, you have to start looking for high yield investments, other investments. How am I going to take this once I get the equity out to keep the interest from burning, because you're spending interest to have that equity out, even though it's minimal, even though it's tax deductible, it's still an expense that is, it's not, if it's not working, it's an expense. Like having an employee sitting on the sideline not doing anything. You want to put that equity or that freed up cash to work right away. So you can do those two things concurrently once you get to that point. So there is an opportunity to kind of set and forget, but then have a checkpoint where you go back and you take a look at, what do I think this property is worth in the fair market right now? What would it appraise for? What are the current loan programs? How much LTV is available? How much equity could I extract? What's that going to cost me? And now what could I go do with that equity that would be profitable? And that constant process is what we call optimization.
The concept of zero-based thinking is knowing what I now know, would I take this action today? Knowing what I now know, would I be in this business today? Knowing what I now know, would I have this partner today, right? That's zero-based thinking. You wouldn't have known those things at the beginning. And so we make the best choices we can to get into debt and get good real estate loans. But as time goes by, the world changes. And part of optimization is saying, knowing what I now know, is this the right loan for the property? And it might be, there might be no trouble at all. Maybe everything's going great. But I think the discipline is to, at least every 5 years, and maybe once your portfolio is big, every year or so, just step back and take a look. Look at your global income from your properties, your global value of your properties, and your global debt, and decide, are the things that I can or should consider doing. That's optimization. It's not set it and forget it. And it takes a while to get around this. In fact, I remember for all those years, Russ, you taught that course called Managing Your Mortgage for Maximum Net Worth. And it was to break these paradigms and talk about these things. And we've had so many Ask the Guys questions that have revolved around this. I thought it was time to really do a whole show and talk about debt. Debt is not a bad thing. Debt is a bonus. Debt makes you money. And if you're smart about it, it really can catapult your returns. So before we're out of here, we have a big announcement next week about the 19th Annual Investors Summit. It's the highest level event we do. We got all kinds of amazing faculty and all kinds of cool people coming, but it's starting to tighten up. There aren't that many spaces left, and yet next week we have a big faculty announcement to make, so make sure you tune in for that. If you want information about the Investors Summit, just go to the website at realestateguysradio.com and click the button that says Summit. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.